pretty much everywhere in the commodities market this week, and we'll go over that. And the reasons, as always, it is China. Well, not always, but usually, as we talk about here, China, big influence on metals. And we are seeing that in iron ore. I'll bring up my charts here and let's get to it. Hold on one second while I get these up. Alrighty. And just bear with me for 1 second. All right, so we got iron ore right here. Monday open, we saw a pretty good drop here. It was 2.32%. These are the Singapore prices. The Dalian prices in China, they dropped a little bit more, but these prices usually track very well together. And now we are still extending lower, about 1% lower today in the Tuesday session for the APAC region. During the US, it's nighttime Monday. And so we got a good little drop here for the week. We are at the lowest since around mid to late March. And the reason for this is even though the People's Bank of China, which is China's central bank, now they have cut some bank rates and stuff, reserve levels, and that's just to try to cut the slide in the yuan against the dollar. USDCAD, if you guys have been looking over there, I'll just pull it up really quick. Pretty intense move going on. We got about a 3% move over just the last 5 days. We're about a little over 3% now, 3.3 about. But this is, if we just zoom out here, you can see how significant this move is here. And this is the 2021 high right here that I marked on this level. And the yuan, it looks like, you know, we had an intraday move over it yesterday, and now in the current session, we had an intraday move over it, but it looks like we're trimming some strength once we go over that level. So certainly some sellers here, some weakness somewhere around this area. And, you know, that does coincide with the 2021 high right there. But what the PBOC did is they cut the rate that banks have to hold their reserves. So that just takes away some, it could strengthen up the yuan a little bit. And it looks like it's working just a little bit. So this is the US dollar making all the moves against the yuan here. Lots of weakness, though. We've pretty much flushed out an entire year and more of weakness right there, or strength in the yuan, and just gave it back all in about 4 to 5 sessions there. So really significant move happening there. And the weakness in the yuan is what's causing the weakness in currencies and oil right now, which is Beijing is starting to lock down, or they are already in the process. Now, over the weekend, they recorded more deaths and more cases, and we are coming out of the Shanghai lockdown, and now we are moving into a Beijing lockdown. So 2 of the biggest cities, and also Shanghai is also locked down. That is a metal hub. We're seeing iron ore react. We're seeing steel prices react. And even though the PBOC is stepping with supportive action here, it really looks like the market's more focused on the demand side. And the demand side is not looking good with these lockdowns. These lockdowns constitute millions and millions of people, lots of factory activity, lots of production, lots of manufacturing. And it's also stemming concerns in a lot of other places, especially with inflation already as high as it is. I believe some officials from the Bank of Canada came out today and said they believe inflation has peaked. And that's kind of in line with what the Fed officials are saying, that we are at peak inflation right now. But, you know, the market doesn't seem like they're as confident in the Fed and other central bankers as they were before. And, you know, that's just what we've seen over the past 6 months. You know, the Fed, they said that initially they said that inflation was transitory. Well, that didn't turn out to be the case. So now it looks like they have a little bit less, it looks like they have a little bit less behind their words right now, and markets are just hesitant right here. So we're seeing the drop in iron ore prices here reflect that in China. Hong Kong also preparing for a COVID surge, actually. They're adding, They just added 3,000 hotel rooms for a quarantine coming up in May. So it looks like they are expecting this to spread. Chinese policymakers and Beijing, they're certainly holding on to this zero COVID strategy. And you know, so far there's really no capitulation on the part of the Chinese government or the People's Republic of China. Morgan Stanley actually just today, I believe in the last hour or so, they came out with a downgrade to Chinese growth. So they cut growth for this year in the Chinese economy to 4.2%. And that follows last week's downgrade from the International Monetary Fund, the IMF. They cut Chinese growth down to 4.4%. So we are seeing Morgan Stanley come out with a bit more of an aggressive cut there to GDP growth. And, you know, I'd probably lean on the side of Morgan Stanley, where growth is going to be more around 4%, because it just looks like these lockdowns are becoming more prevalent across China. I believe 82 out of their 100 largest cities have been in some form of a lockdown over the past week. Take that with a grain of salt, because that is just an estimate. It's not from the Chinese government itself. And they are playing not the facts, but the statistics around all of their cities and things close to the chest. Now, of course, a lot of people just don't trust Chinese data at face value. And, you know, that's, if you don't, you know, you don't. If you do, you do. But I'd like to take their figures with a grain of salt, at least. You know, we just really don't know what we're getting, just because they do have such of a tight cap on things like the media and headlines getting out regarding these situations. But definitely good to keep your eyes on. Metals and oil is going to react. Actually, let's go over to the oil prices right now, and we'll see what's going on over there. They are down a bit, studying right now around 0.25%, but these past 2 days, they are not looking good. Now, Monday's open for US oil, which is WTI. We're down 3%. Brent prices, I would imagine Brent is a little more than that. And it looks like Brent dropped, a little more. That was 3.43% to open the week. And now it looks like we're studying just a little bit. Now, we also had that big drop in Chinese stocks, and that just kind of highlighted the internal risk to China with their equity pricings. But right now, demand side is not looking too good for China. The Australian dollar, Roland and Ann, you guys asked about that. Let's go look at the Australian dollar, how that's reacting. So just as we look at the Australian dollar, keep in mind that Australia very sensitive to iron ore prices. Iron ore is one of their biggest exports, and a lot of that does go to China. And here we go. So Australian dollar just giving up a lot of ground to the US dollar over the past week. We had the open on Monday. We're down 0.75%. Right now, it looks like we're kind of in line with what commodities are doing. A little bit of a steadying here through the Asia Open, and we'll see how that plays out through the day. If I had to guess, this bounce right here, we're not really seeing anything from it. Might just be sellers taking their foot off the gas, but for me, I would expect us to keep seeing the Australian dollar weaken a bit versus the US dollar. And also the US dollar is receiving some haven flows just from the auxiliary effects of this China lockdown. Demand side of the economy going down, China's demand going down certainly raises the chance for a global recession. And we'll have to see how these forecasts come out. For oil, at least, a lot of analysts are really stepping back from that 200 price level that we saw. A lot of calls through the first few weeks to a month of the Russian invasion of Ukraine. We had a lot of calls for 150 oil, 200 oil was a little less common, but they weren't that rare actually. And what we've seen the past few days over the weekend as China really ramps down or, steps up these containment efforts is that a lot of analysts are pulling back pretty quickly from those those calls there. And China, like iron ore and metals, they're just such a huge influence on oil demand throughout the world that, you know, those prices really suffer there when they're shutting down cities, especially major mega cities like Shanghai, Beijing, Shanghai. Um, just a lot of demand taken out from the economy there. So as iron ore prices go down, as oil prices go down, certainly not good for commodity sensitive currencies like the Australian dollar. So we're seeing that right here. Now we have the full retracement going from this March swing low here, and that was off this trend line back there. So if this breaks right here, you know, we have some open room to fall all the way down to this trend line over here. We also have this psychological 7 level right here. So, you know, if we do see this weakness continue through, if we do see iron ore prices continue to fall, oil prices continue to fall, I wouldn't really put it outside the realm of possibility that we could fall all the way back here. Now, this move's already starting to get pretty intense, but there's probably more room to go, and we can see that just through the relative strength index right here. We're not technically into oversold activity yet. We're at 33. Oversold conditions would be below 30. But if we cross into that, just because it's oversold and below 30, that doesn't necessarily mean that people won't keep on selling. That's just a technical oscillator that gives you a reference point historically or in reference to a period. It doesn't mean that prices can't keep going down. And when you do see a move into oversold territory, usually prices could continue for another week or two. If we go back on the chart and look into the last one right here, when we went into oversold territory at 30, that was on or right around November 25th. And you saw that prices were right here. And look what happens. We kept on going down, kept on going down, kept on going down until we bottomed right here in the beginning of December. And the RSI went down all the way to 21, right around there. So that was to 3rd of December from 25th of November. So about 2 weeks of more downward price action after that RSI went into 30. So, you know, keep your eye on that. Usually a lot of traders even use a move below 30 or above 70 as a signal saying, you know, this move is extremely strong. It's probably going to continue for at least a little bit. And, you know, some people use that as a buy or sell signal. Myself, I don't necessarily, but I'm not one of those people that think just because it crosses in at 30 or 70 that the move is done. That's not really what the oscillator means. That's not what the signal is supposed to mean, even though it's there. Just because the name kind of implies that people hear oversold or overbought and think that, oh, if it's overbought, you know, prices have to come down if it's overbought. They do have to come down eventually, and they will usually when that oscillator gets above or under 30, but you know, that does take time, so just keep in mind on those moves. But Australian dollar, really interesting moves here. We also have the 20-day simple moving average coming down towards the 50, and then the 100 and the 200-day, we've already crossed below that as well. So some really good weakness here. And you know, along this full retracement, I could expect to see some leveling out before the next move would be followed through on, but we'll have to see how that plays out, and we'll check back next week on that. Let's go over to dollar loonie and see how that's doing. Now US dollar making inroads against the Canadian dollar. In the past few days here from last week, we've crossed above the 200, the 100, the 50. So some pretty good move here. The MACD just crossed above its center line. That's certainly a bullish sign for a lot of people. RSI also crossed above its 50 center line. Again, bullish. So technical is looking pretty good here with that move. We have this former triangle here. We sliced right through that. We got this 23.6% Fibonacci level right here. And that's from a larger move out here to here that I do not have the levels drawn on, but it looks like this 23.6% fib level is providing some resistance. So I'll just put those fib levels back on just so you guys can see them. In my opinion, it's always quite a lot because you do see these, as we do here, these levels being respected. All right, let's go over to copper. So copper, same story as other metals, you know, iron ore, copper, things like that, the industrial metals. They usually respond largely the same, just to different degrees, but they usually respond to the larger macro themes, at least when we do have them. So these China headlines, you know, producing a lot of sentiment sway in the markets, a lot of bearish sentiment as we had Chinese stocks dropped. I believe they're doing the same thing as metals today. They're kind of steadying a bit here. And they got kind of a boost from the Wall Street session. Stocks did pretty well, so kind of some follow through right there. But, you know, as these lockdowns continue, I'd expect to see the sentiment sour again, or at least not recover to where it was. But copper, definitely an interesting move here. We're right at the 200-day simple moving average from overnight. And we did have that intraday move under it, but it held. So 200-day simple moving average, there is some support there. Perhaps we can see it offer more support if prices continue to go down here. But we sliced right through the 100-day moving average, and that was pretty much, you know, just a function of how strong the move was. Copper, very sensitive to China, as is iron ore. China uses a lot, if not the most. I believe they are the largest consumer of copper, but I'd have to check on that, but I do believe they are. Saeed, gold, US dollar, yeah, we could go over and talk about that. So again, as we switched over the chart, we see that gold is kind of you know, acting the same way as industrial metals are right now. Now, partially because of that US dollar strength, we've had a lot of activity in yields recently. We'll just go over to the 5-year Treasury yield, take a look at that, what that's done. 5-year yield has come down, so some bond buying again, and that could just be on these haven flows. But it's interesting that gold isn't kind of catching some of these safe haven flows right here. But again, we did have the US dollar catch a lot of those safe haven flows. Gold usually doesn't react well when the dollar is stronger. If we go over to the US dollar index, DXY, we see that it did open Monday with a pretty good 0.61% move. Now we're coming down just a little bit here. So a little bit of US dollar weakness that could be good for gold, but we're pretty much flat, just up 0.15% here. But right at this 1900 level right here, it looks like we're getting a bit of support, and that's a psychological level. We saw it in mid-February when prices had trouble getting over this 1900 level. We see that we had 1, 2, 3, 4 days until we really tried to really break out of it, but then sunk under it again. And then we've had these intraday moves below it that have supported 1900. So for gold bulls right here, it could be a chance to add to your positions if you're bullish on gold. You know, so if you believe inflation is going to continue increasing, it could work as an inflation hedge. Higher inflation means central banks have to catch up, ramp up policy faster. And we have seen a very hawkish shift in Fed rate hike bets. We've even had some chatter of a possible 75 basis point hike being on the table. But right now, or at least the last time I checked, overnight index swaps are pricing in 50 basis point hikes for the next 2 meetings, the next 2 FOMC meetings, and that is pretty bearish for gold in itself, just being a non-interest bearing asset. More hawkish Fed causes more people to ditch their bonds. That pushes yields up. Higher yields are also bad for gold, also just because it's non-interest bearing asset, and those treasury yields, they start yielding more, so you know that takes away some of the appeal. Also, real yields are flirting, or some real yields are already in positive territory. Very bearish for gold as those inflation index yields are no longer negative. So a lot of selling activity in gold over the past week, but again, we're at the 1900 level right here. So a lot of those that are bullish on gold could be a buying opportunity right here. So we really want to watch gold prices at this 1900 level. If we make a clean break away from 1900 below it, that's certainly bearish. And then we'd be watching this 100-day simple moving average right here. And it looks like we also had some resistance right around the